Hi, this is Mike Yan. I'm a client portfolio manager here at Westwood. Today it's my pleasure to introduce our market outlook call. We've got Leah Bennett, president of Westwood Wealth Management, and Adrian Helfert, CIO for alternative and multi-asset portfolios. Today we're going to discuss questions about the U.S. federal debt sitting at $34 trillion, what that means for our economy, and how does the political landscape affect that. Leah, Adrian, good afternoon.
Good afternoon, Mike. Nice to see you.
So much, Mike.
Great. Well, we'll start with first question about U.S. debt. As we've seen lately, last couple of years, that the U.S. debt ceiling becomes a topic in the news almost annually as we debate on raising the debt ceiling. Can you guys speak about our national debt and the role that the government revenues and fiscal spending play in maintaining a healthy debt level?
Sure. Maybe I'll start with this one. The debt ceiling has been topical for the past several decades, and increasingly so as it's been, of course, used as a political instrument to exert force on one side or the other. The funny thing about it, though, is that in nominal terms, it's a number which doesn't make a whole lot of sense because, of course, federal debt is going to increase as revenues increase. And if revenues were to increase significantly, as we see inflation over long periods, then you would expect debt to increase. But it's one way to measure how much we have overall. The current discussion that we're having kicked off where we, as you mentioned, we hit the federal debt level or the debt ceiling at around 34 trillion in January of 2023, and then we passed a debt moratorium in June of 2023 that's going to get us to the beginning. I believe it's January 2nd of 2025, and probably about December 2nd of 2024, you'll see all the press talk about how we might actually breach the debt limit and what's going to happen, and then we'll have the Congress and others that will be talking about how do we raise the debt limit. That's where we are now. The debt limit, of course, does not authorize new spending. This is just funding past spending levels. So, as I say, the debt ceiling itself is a political instrument. In many ways, to me, a good metric would be more measuring debt to GDP levels and saying how we should keep our economy in check by not having too much leverage of the economy, not having too much debt per unit of revenue. But in dealing with this one, it's not a bad constraint to have in order to still ensure that we're continually looking at how much debt we have in one aspect or another. But it does lead down the path of the discussions that we have and the concerns that we have. If we don't fund our past spending, then could we potentially stop funding federal employees as we have done in the past, or the National Park Service, or emergency services, or other areas? And that itself leads to constraints on the economy and negative impacts. And maybe most importantly, negative impacts on consumption and consumer behavior, as there's just uncertainty that gets raised. That's probably the biggest impact of the debt ceiling itself, of if we don't authorize a higher debt ceiling when we need it to fund past expectations of the budget, then let's say federal employees, which are a large portion of the U.S. economy for better or worse, suddenly get worried they can't, they're not going to get paid anymore. They can't make their payments on their mortgage, et cetera. And that leads to negative impacts on consumer spending. I'll just stop with the debt ceiling there and see, Leah, what your thoughts are.
Yeah, a couple things. I mean, if you look at debt to GDP, I agree. You've got to look at the ratio. If you look at debt to GDP over the last 20 years or so, on average, it's been right around 100%. So we've been able to. So we've had some coverage, and now we've started definitely moving up above 100%, which is certainly concerning. I mean, there's several problems that we kind of run into that we've got to consider. One is, if you look at Medicare and Social Security, it's such a large percentage of our spending, with the baby boomers still moving through moving through our systems, I think the vast majority, the biggest peak of projected deaths, which you hate to say that, but from the baby boomers isn't until 2055. And if you look at the fiscal stimulus that is related to Social Security and Medicare, it's almost 3 trillion in spending. So that's double what we spent on any, as far as the discretionary budget items, on anything else, and which includes education and defense. So then you've got to look into kind of the incremental programs and where can we get some savings, and where are we spending money from a stimulus perspective and actually getting a return as it relates to the multiplier impact. I think there is something I try to think about a little bit when we're talking about the debt levels. And again, I don't think there's an easy solution, but I try to think about the revenue side, which is also really important. Obviously, revenues are not keeping up with spending, and we've got to have more discipline. But it is important to think about the revenue side, because I think a benefit the U.S. has that other countries don't have as much is how much we still have in entrepreneurs and self-made wealth. So if you look at, we take a service called WealthX, and the ultra high net worth population, 72.5% of the population say that their wealth really came from their first generation wealth. So they've been the wealth creators. And 27.5% was inherited wealth, which is actually done from the last survey, which was done in 2016, which showed about right around 34% of wealth was inherited. So that's important as it relates to tax receipts, which is really important. So tax receipts, if you look over the last 5 years. So I tried to go pre-COVID as opposed to just looking at the COVID period. But if you look at tax receipts from like 2018 until 2013, they were up 48%. So they'd risen from 3.3 trillion to just under 5 trillion, which is encouraging. It is encouraging to see our revenue increasing as opposed to a situation where we're continuing to spend and we're not seeing revenues kind of rise at all. But again, we've got to get the debt spending under control in order to reduce those ratios. I am curious. I mean, Adrian, you kind of mentioned the impact of to the consumer. I'm kind of curious to kind of hear more of your thoughts on that topic.
Yeah. Oh, well, you brought up a really good point around the multiplier, and the fiscal multiplier is something that's somewhat hotly debated on how much does each incremental dollar of either spending or tax cuts lead to an incremental dollar of economic output. So your GDP increase. And historically, it's ranged between about 0.5, so $1 of spending leading to 50 cents of incremental economic output, to 2 or double, a leverage. Historically, this has been in like about 1 on average, and now recently it seems to have come down some. It's just kind of what you mentioned of we've seen less of the economic output as each incremental dollar of spending, and maybe related to just higher interest rates. In a lower interest rate environment, you might expect, because kind of like a corporate, you get lower cost of capital, you get better return on your capital projects. Similar for the U.S. government, where now more elevated rates, and you expect that fiscal multiplier to come down a little bit, which it has, which means one of the ways that we should be bringing down our debt, because the ways to bring down our debt are not just to reduce debt, but to increase spending above what our necessary needs are, and then paying down with excess capital. If we are spending but not getting the fiscal multiplier, we have less likelihood of having the excess capital to pay down our debt. So, one of the big questions is, how do we bring it down? Well, spending is going to be key of decreasing the amount of spending. And, if you're on the, one side or the other of the aisle, then taxes have this similar fiscal multiplier. What does each incremental dollar of tax hike or tax cut lead to on the economic output side? They run about similar in nature. And as it stands now, we've seen the fiscal multiplier for taxes come down a little bit even further. Not good. So tax cuts may not help as much as we would like. That's kind of where we are. On the consumer side, there's a whole separate multiplier as it stands there, and it really depends on where we spend the fiscal. If the fiscal is more highly spent on the defense side, maybe that helps less than consumer-oriented programs. But that's also, it's tough because 2/3 of our budget, you mentioned mandatory versus discretionary spending. There's really three categories when you think about fiscal budget. And it's mandatory spending, that's Social Security, that's Medicaid and Medicare. That's about 2/3 of the budget. That means you can authorize changes without congressional approval. The discretionary side are things like transportation and education and defense, where you can effectuate changes and you can start to enact those changes you think might be pointedly most appropriate for the environment you're in, whether it's higher geopolitical risk and higher defense needs and replacement cost, or concerns around industrial production that may impact the consumer further. That's where you effectuate that. And the third category is that we don't talk about much, but we're going to have to, is interest cost on debt. And the interest cost on debt last year as a percentage of the budget was around 13%. That was with an average rate on US bills around 2.8% for what the US government is funded at. Of course, that's gone up significantly, and the estimates for how much that might go up are on the order of 50%, significantly so, as the US government has to roll its obligations, its debt obligations, to higher yielding securities and pay more in interest cost. That we're going to see go up significantly, and they're funding in a little bit shorter maturities. As we drop our interest rates vis-a-vis monetary policy, that will help potentially in the future. But for the next couple of years, expect to see that's going to be a negative ramification for how much debt we have, because interest costs are simply higher.
I mean, if you think through, yeah, it's unfortunate kind of the timing of when we took on so much debt, or really increased our debt in the last few years. I mean, certainly COVID was a period where the deficit went up considerably. Some programs seem to have made sense, others not so much. And then we've kind of just continued to accelerate. I think it was 2016 through 2020 was the first time that tax receipts actually went down when we put through a tax cut. I believe was one of the first times that's occurred. But yeah, I mean, I definitely try to think through how are we going to have better discipline on the fiscal side and make sure we still continue to have levers that we can pull when the economy slows, which is eventually going to happen for sure. And then also, I think it's really important to think through those programs and how they target younger people. So if you think about where a lot of why demographics are so important globally is you look at some of the countries that have really significant debt to GDP issues where it's going to be really difficult to get out. So I'm thinking of Japan, where debt to GDP is over 200%, as well as China, and they have declining populations for a variety of reasons. In the U.S., at least, I think around 30% of our population is under the age of 35, and those are first-time buyers, which is very helpful from a GDP growth perspective. So if you think about a first-time, somebody who's under the age of 35, they're buying a house for the first time, they're buying a car for the first time, they're like first-time consumers, and they have the biggest impact on the economy. Whereas somebody who is later in life, they're trading up on their home, they're trading up on their car, so there's an incremental purchase there. So a younger population is really important. And if you think through globally, like India is in a great position from that perspective, Indonesia, a lot of the Latin American countries, but that's something else I kind of think about as it relates to our ability to dig out.
It's a good point, and I periodically think about property tax receipts, as well as full tax receipts that'll be sales tax receipts, et cetera. That helps state governments primarily, but vis-a-vis federal handouts, this does help the federal deficit. So as we see property prices increase, so as you're talking about demographics, very important for the potential for as we're undersupplied on the U.S. housing market, and we still see demand, and so we see property prices increasing. That does help on property tax receipts or the revenue side of the equation. So there is a stronger impulse, I would say, in the United States than we see in many other countries, where we still see good demographic metrics that will lead through to better receipts of the future for government policy.
Great. Thank you both. Looks like there's a lot of different variables on the revenue and the fiscal spending side that we can work with to help manage our debt. Another quick question that we've had come up, and it's also been in the news a lot. How does this debt level affect the U.S. dollar? We all, being in the U.S., benefit greatly from the U.S. dollar being the reserve currency. But are there any concerns about the U.S. dollar and its place in the world as the reserve currency going forward?
At this point, that's far enough in the future. There's always a concern, and I'm an old fixed income guy, so I've got concerns about all kinds of things. But there's always a concern. At this point, it's a lower concern. And let's talk for a second about a global reserve currency and what that means to us. It means a lower borrowing rate. It means we are the primary position of holders for U.S. Treasuries, for the Japanese central bank, for the Chinese central bank, for the European central bank, because we have the deepest pool of capital, the largest and most liquid base of tradable securities. We have confidence that we're not going to overinflate by poor fiscal policy. We have the ability, we have more political stability than we see in many of our peers. When those things start to break down, i.e., we don't have confidence in our leaders to not inflate our way out of debt, which would be effectively a default on our external holders like the Japanese central bank and the Chinese central bank, then we're the sole source of the global reserve currency, which is going to take down our capital cost as a country, allow us to fund projects effectively cheaper, and it helps our growth. Should we lose our status, then it will be a negative for long-term growth. And when I say long-term, I mean multiple decades. And that's historically, we have seen changes over a global reserve currency. The UK pound used to be a reserve currency. It was the last reserve currency. And I want to say that lasted for about 70 years. So it is very long. I don't see it as highly likely in the near term or even the medium term. We'll start to see much more deterioration in either those things I mentioned, which are political stability, nothing like we see now. The concern that our leaders and our populace are pushing for policies that would be significantly inflationary or lead to a lack of confidence that we would actually service our debt, because default on government debt isn't necessarily that we stop paying our obligations. An external default on your public debt is where you try and inflate your way out of obligations. You simply print more debt. If we were to do that wholesale, then that would be a concern, but I don't think that that's a near-term concern for us.
Yeah, I agree with Adrian. I think it's definitely a longer-term concern and something we've got to be focused on, and we've got to make the right changes. And we've talked about having better controls on spending, which for sure needs to be in place. But if you really go look at the alternatives globally, there's not an obvious choice. Again, we've kind of talked about Japan and China. Debt to GDP is over 200%. If you look at the UK, it's over 100%. Most countries are pretty debt-ridden at this point, which doesn't make them more attractive than we are. And then if you look at some of the proposals, you had the proposal about a currency that's backed by oil, that and the sponsors of that were India, Russia, and Brazil. And you've got a lot of questions about as it relates to ethics with Russia and Brazil. You've got kind of corrupt countries involved. So I don't think that would really fly globally. And then if you look at something like Bitcoin, Bitcoin has been a very attractive asset for many people, investment. I mean, it's done well, but it doesn't necessarily have the same earmarkings as a currency. And so if I think back, I mean, just to use a personal example, I went to, and to tie off one of Adrian's comments, I went to Argentina for the first time in I think it was 2013, 2014, and people in Argentina was going through one of its many crises as it relates to government spending and some of the policies that they had in place. And people were taking their paychecks and they were buying cars. And the reason they were buying cars is because it was depreciating a lot less quickly than their own currency was. And so people were looking for a means to protect their buying power. And if I think about something like Bitcoin, when you have something that's very volatile as an asset class, you need something very stable as it relates to a currency. And maybe that's something that develops longer term. It'll be interesting to see. The concept of having a finite number of units is very attractive, but I just don't think there is a viable alternative to the dollar, at least in the near term, in my opinion.
Great. Well, thank you both. That was very insightful. I hope that helps all of our clients get a little bit more insight into the U.S. debt and the U.S. dollar. Again, if you have any questions, please reach out to your advisor, and we'll see you next time.
Thank you all.
Thank you.